What's going on, everybody? It's Matt, aka the Lumberjack Landlord, here with some super exciting and amazing news. And finally, we can finally start to see a decline in the market because Fred, the Federal Reserve Economic Data that actually tracks median home prices, yeah, you guessed it, it's finally down, but it's not a crash. Don't be concerned. Now, while I'm going to take my victory lap and say to those that said, hey, it's not going to go down, it's going to keep on going up, well, all right, it's now down. Now, at the same time, too, I'm not doing that big of a victory lap. Certainly not going to break my arm, pat myself in the back, because it went from 468,000 in January, last year. It went from 468,000, which was the peak. And then this month, it came in at 467,700. I don't think we need to worry about that crash, anybody. I think the crash is canceled. But anyway, long story short is I wanted to make sure to do this video because we still see and hear all the noise. All these crashers sound dumber and dumber every single time they post a video. Oh, well, now I guess it's, didn't happen at the end of 22. Didn't happen at the beginning of 22. Maybe it was related to rates. Like all the actual people that know what they're talking about have said it was related to rates. Our transactions crashed. Yep, they are. No one's busy. Every single agent that I talk to that normally does anywhere from 3 transactions a month to 10 transactions a month is doing anywhere from like 1 to 3, 1 to 4. So yeah, their business. Yeah, if you're a mortgage broker, unless you're amazing, like Matt, the mortgage guy, your business is sucking. Why? Because you weren't adding any value all this time. You were just waiting for the phone to ring. Big surprise, it stopped ringing. Unless you know how to create business, you have no control over how much business you're going to actually close. So while the transactions are off heavily, now we're actually starting to see with rates, they had come down a little bit. We started to see some more activity. Again, everyone like, oh my gosh, refinances are down 80%. Well, what moron out there is going to sit there and go, hey, so I know I've got a 3% mortgage or a 3.5% mortgage or even a 4% mortgage. I really feel like I'm missing a 6 in my life. So let's just go refinance now. No one's doing that because you'd be stupid to do that. It's just math. No one wants a higher payment. Why would you? That defeats the purpose. We don't get approved based on the price of a house. We get approved based on the payment and what the payment's going to be. And that is price adding in what you're going to pay for a percentage on your mortgage. That's why the transactions are down. So what I would continue to tell you is be encouraged. If you're an investor, a deal makes sense when a deal makes sense. If it's going to return to you 10, 12, 14, 16%, does it matter if the interest rate's 7 or 9 or 11? Does it matter if the house is 500,000 or 800,000 or $1 million? No, it doesn't matter. It's about return on the capital that you're investing in a deal. Now, if you're a homeowner, again, I get that you want to catch the falling knife, but you need to understand there are literally hundreds of billions of dollars of cash sitting on the sidelines waiting for even a 5 or 10% correction. Those investors will buoy the market, and what they will also do is they will prevent that crash from happening in a meaningful manner. While there might be certain markets, and the markets that I've been talking about for almost a year, the ones with iBuyers, the Arizonas, the Vegases, and things like that. Guess what? I've been still shopping for a home in Vegas. Guess what happened? A lot of stuff stopped going down and inventory started moving again when we got out of the 7s and into the 5s. And now there's creative products where you can also do a rate buy down and get into the 4s. So as I've continuously said, it is a payment game. That's what it will always be. That's all that ever really matters. So while all these crash bros wrap themselves into human origami over this is what's going to happen, bro, don't quit your day job. I understand you have a lot more time on your hands now because your transactions are down by 50 or 60%. No doubt you're going through depression right now. You are going through a financial depression because all that easy money that you were making for all those years, it ain't coming anymore. But my hypothesis and my formula for how the median price will continue to drive downward, I believe is still intact. I've said since day one, we're going to have a 10% to 20% correction in median home prices. The reason that I believe that is there are markets that got way overinflated. And when those way overinflated markets, when they start to shift, obviously pricing is going to come down. A lot of that stuff is still above the national median price. So what I'm really looking for, what I continue to believe will absolutely start to cascade a little bit more, is that as job losses start to, pile up, I don't think we're getting to 10% unemployment. I think unemployment probably gets close to doubling over the next 2 years. So as that starts to happen, yeah, I think it's going to be a low, slow, heavy slog. But again, this is not this wicked crash everybody's talking about. Didn't happen that way. It's nothing like it was back in 07 and 08. Take it from somebody that was actually investing back then and knows what they're talking about. It's not going to happen that way. I've been saying it for a year because I actually know what the debt looks like, and all these clowns talking about it have no calculation for how it crashed and why it crashed the way it crashed. Because when we started crashing, we started putting 250 to 300,000 houses a month on the market from foreclosure. See that big foreclosure wave yet? Oh, we're not still at median? Oh my goodness. Well, that's wrong. As you continue to dissect the numbers, they continuously are wrong on every level. There's no doubt that there's going to be fluctuation in local markets, but there's over 400 markets in the US that are watched and managed. Are you trying to tell me that they're all going down? Come on, just stop. Come on. So as we continue to look at this, I think it's encouraging. It is going to go down. There's just no doubt in my mind that it will go down. But why is that median house price really actually going down? Because almost all the activity is not in new construction, which is exactly what my theory was. You are going to see the newer construction median plus home prices, which is almost everything that's built. I thought that would slow down dramatically because it was so expensive and rates were higher. Now we'll see blips and we'll see guys continue to develop stuff, but it's not going to be enough to compete with the amount of transactions happening, median minus, right, in the older properties. Here's a perfect example. Properties in my area are $700,000 for a 3-bed, 2-bath, 1,750 square foot house. Yeah, expensive. Here's what I'll tell you. A 3-bed, 2-bath home that was built in the 70s but been nicely remodeled sells for low 4s. High 3s, low 4s, depending on the neighborhood, but high 3s, low 4s. That actually pulls the median price down. So while new construction slows, while new construction continues to be a smaller percentage of the transactions happening, the other things that contribute to a higher median price also continue to slow. If you look at Vegas over the last 90 days, the number of luxury properties, which is 1.5 million and higher, that's what I look at for my studying, is $1.5 million and higher. That volume is down about 35 to 36%. So when you have that many fewer transactions occurring on the high end, now if you look at the median home price plus, so that range between median home price and luxury, guess what? That's also down. It's down in the last 90 days, about 20-odd%. So what are we left with? We're left with the transactions that are occurring at median minus. What does that do? Well, if you take out the transactions here, and you take out the transactions next lower on the move-up buyer, and now a majority of your transactions are happening at just over median or median minus, that's what actually pulls it down. Does that mean the people that are median minus are actually getting a good deal on their home? Nope. Those are still flying off the market because there's no inventory in that pricing segment, and there's plenty of people, even at 5 and 6%, that can buy. The people that are really getting hurt are the people that are median plus and luxury. Because when your portfolio, stock portfolio that is off 20, 30%, you usually say, you know what, we're just going to hold off on that purchase. Or you might have been overextended, crypto bro, and you might need to, sell because you don't make any money holding Bitcoin. You only make money when you sell it or when you're trading it. And even if you're trading it, You probably don't make that much money because plenty of people didn't make money trading it either. Pretty tough to trade at any time when something goes from 70,000 down to 20,000. So I think it's really interesting. I wanted to take you guys through all these numbers. Hopefully this is helpful and can make you the most popular person at the party that actually knows what they're talking about, because you're listening to the Lumberjack Landlord, who's actually an investor and doing deals still in this market today. That's right. We're still trying to put other deals under contract, but we most recently closed on something just a few weeks ago. So continue to watch this market develop. I believe that the median price will continue to come down, but that's not a true indicator of what's actually happening in the market. Yes, the median price is coming down, but if you're a median minus housing cost, guess what? Those are still coming off the market pretty darn quick. So I think that that's something that we need to continue to watch. Again, I'm not telling the future saying, I know this is going to happen because I have a crystal ball. This is just based on what I understand about the debt, what I understand about the market, the fact that I talk to investors all the time, and literally even small investors like myself, 7 figures sitting on the sidelines waiting to deploy. I don't need a 20 or 30% price reduction. People buy on the way down, and that helps buoy it up. That's why it's going to be a slow burn. And I truly expect it to take the rest of this year and next year as well. Now, the caveats obviously are world war and that sort of stuff, massive geopolitical events. But if we're just talking regular housing and the market as it sits, this is largely the way that I see it performing. But again, you don't have to take my word for it. I'm not even asking you to take my word for it. I'm an investor. I continue to invest based on evaluating every deal as it comes across my desk. I evaluate it then based on those numbers, based on what I can acquire it for, based on what the cost of my debt is, and based on what the return on my capital is going to be. So long as you evaluate deals like that, it's pretty tough to get into trouble unless you're leaving yourself not enough margin to have to worry about compression of taxes and things like that. So hopefully this is helpful to you guys. If you haven't already liked and subscribed, I'd love for you to do so. Also, check us out on Sundays on our live stream because, it's a lot of fun. And we get a lot of great questions that even if you're not asking the questions and you're a little too bashful, we get a lot of good answers out there. So as always, we try and create great content for you. Appreciate you stopping by and look forward to seeing you in the next one. Take care, everybody.